$700 billion. That is how much big tech plans to spend this year on AI infrastructure alone. The handoff. $5 trillion in new market cap, most of it in 5 names. 28% of the index, all in the same trade. $200 billion a year in capex, deployed against revenue that may never arrive. Every rally has a supply side, and right now the supply side is moving. Forget the price. Follow the paper trail. Who owned it 6 months ago? Who owns it now? The headlines won't tell you this story. The shift happens underneath the surface, in the filings, in the flow data, in the rebalancing mechanics that no one talks about on air. What distribution actually means. Each filing looks routine on its own. Together, they map a structural transfer of risk ownership, not a sell-off, a rotation. This is the feedback loop. Narrative supports price. Price raises index weight. Weight forces passive buying, and that buying supports the price all over again, even as the original sellers quietly move on. The chart shows how concentrated the index has become. What it does not show is who added those shares, and who is starting to let go. More than half of all US equity capital now follows mechanical rules. Not conviction, not analysis, just math. And that math is price insensitive. BlackRock's own filings show the scale, $11.6 trillion under management. The rebalancing engine runs whether anyone is watching or not. Price does not just reflect demand. Price creates demand. The flows keep arriving, long after the conviction behind them has already gone. Automatic, structural, indifferent to valuation. Why smart money still participates. One wrong call on one name, and you are trailing the benchmark by a margin that triggers, let's say, rather uncomfortable client conversations. That gap creates a cascade. Underperformance leads to outflows. Outflows threaten the mandate. The only way to protect the mandate is to buy the same crowded names everyone else owns. Once that capital is deployed, it becomes a bet you cannot unwind. $55 billion committed in a single fiscal year. 4 companies now account for the majority of AI infrastructure spending. The scale of that commitment has no modern precedent, and every quarter it compounds. If the price looks strong and the narrative is intact, why is ownership shifting? That is the question this structure is designed to obscure. Watch the direction of the flow. Fast capital trims into strength. Passive products absorb the supply. The exposure stays the same. The hands holding it change. Over $1 trillion in just 5 positions. When every major allocator holds the same names, the exit becomes a coordination problem no one wants to acknowledge. 48% of revenue from 5 customers. The same customers building the infrastructure everyone else is valuing. The circularity is right there in the filing. This is what career pressure looks like inside an institution. Not panic, not fear, just math that leaves you no choice. Who receives the risk? Ownership is migrating. From hedge funds who evaluate daily, to pension funds and index vehicles that hold by rule, not by conviction. This is not coordination. There is no conspiracy. It is plumbing. Rebalancing rules do the work automatically. History shows this pattern clearly. Concentration builds, exits crowd, and when the turn comes, the repricing is faster than anyone positioned for it. The template repeats across decades. Nifty 50, .com, the GFC. Each time the arc is the same. What changes is who gets caught holding at the top. The technology can be real, the products can be transformative, and the ownership structure can still be fragile. These are not contradictions. The prospectus itself flags the risk. When 10 holdings are nearly 40% of the fund, liquidity and stress is a question mark, not a guarantee. The system holds as long as new buyers exist. Stress begins when every participant looks around and realizes they are all waiting for someone else to take the next block. When everyone shares one trigger, the clock does not slow down, it accelerates. What breaks the handoff? Look at these 4 filings together. Combined capex north of 200 billion. Concentration tightening. Revenue growth decelerating from peak. The signals are in the documents. The sequence is predictable. Guidance softens first, then estimates reset, then de-risking begins. And then the flow reflexivity that built the position reverses it. Distribution ends the moment the last marginal buyer steps back. Not with a crash, with an absence. A bid that simply is not there anymore. At the turn, the tape moves before the story shifts. By the time it is reported, the handoff is already done. If they diverge, the invoice arrives, quietly. This is not a prediction, it is a map of who owns what, and when the hands changed. If timing diverges from pricing, the invoice arrives, all at once.